The results for Q2 2012 were pretty good, pretty solid, and broadly in line with our expectations. The sales figure of 32.1 million was the second highest quarter ever for LMA, which was pretty good. It was within 1% of the highest quarter, which was in Q2 2011. If you actually look at that though in constant currency terms and you adjust for the discontinued product lines, the non-core product lines that we stopped at the end of last year, then the actual growth was 3.9%, which is generally above market rates. For the operating income, 4.7 million was up 10% year on year, which we're pleased with, and EBITDA was up 2% despite unfavourable currency movements. The balance sheet, as usual, finished pretty strong. We used some of our cash in the quarter to invest and build inventories, but we ended up in a pretty solid position. I think the main pressures for Q2 have been the challenges in our more mature markets, where we know that they are highly competitive, and obviously within the current economic climates in most of those markets there are price pressures. Despite that, our US business grew by 3% in sales terms, and that's really from leveraging the sales force, bringing in new distribution contracts that we recently announced with Fuji, with Vigon and with Ace Medical, which expands the product range. And if we look at the international markets, the sales, whilst the sales there were 2% lower than last year in reported currencies, the constant currency, and if you adjust for the discontinued product lines that I mentioned earlier, then actually sales grew by 5%. And here I think it's really the developing markets like China that continue to show tremendous growth, which is compensating for perhaps the more sluggish European markets. If we look at the key factors in between the headline, sort of top line and bottom line figures, I think we first need to look at gross margin. We said at the end of last year that we expected to maintain a level of around 59%. We achieved that in Q1, and we've achieved that again in Q2, which is pleasing. There are a number of factors that affect the gross margin line. It's no mean feat to achieve 59% when, for instance, exchange rates, the US dollar to Singapore dollar, compared to last year, have been moving against us. However, we've got a number of initiatives going on to reduce costs, particularly the distribution and warehousing costs, and they've started to bear fruit in Q2. So again, that's helped contribute to that 59% level. If we look at SG&A, I think that's broadly flat year on year, which I think again reflects our ability to keep costs under control. The other factors really are the R&D line's a bit light in terms of spend in this quarter. That's more really a factor of timing of projects and when we need to outsource some costs rather than use our internal resources. The other factor in the quarter was the increase in unrealised losses on exchange. This is really forward contracts where, again, primarily the Singapore dollar moved against the rates that we had contracted. So overall, there's a few ups and downs in those factors. I should perhaps mention also the tax charge for the quarter, or more the comparison to last year, because there was a big credit when we were able to release some uncertain tax provisions as a result of the settlement of our IP dispute favourably with Ambu. So overall, some ups and downs in the quarter, but I think overall now bringing around to the first half results show on a more like-for-like basis that I mentioned earlier, 6% sales growth, which is certainly above the market rate, and with operating income and EBITDA being up on last year by 13% and 11% respectively, it's a very pleasing overall performance for the first half.